In this video lecture, we're going to be looking at methods that are used when a set of transactions does not meet the revenue recognition principle, allowing revenue to be recognized at the point of sale. So we're going to describe what's called the installment and cost recovery method and talk about when we would use these methods. GAAP says that when there is no reasonable basis for estimating the collectability, that is, we're not sure that we are going to collect on a sale from a customer, we have to delay the recognition until the uncertainty has been resolved. And again, this collectability it typically centers around the customer's uh, payment, whether we're going to receive it or not. So we're dealing here with high-risk customers, customers who do not have good credit ratings. Uh, so we're willing to take a business risk, typically because we're selling at a higher price. But because of that, we're going to have to delay the recognition of revenue. The FASB code defines the installment method as a way of allocating each cash receipt, a little bit going to the recognition of recovering the cost of an item, and the remainder going to the recognition of gross profit. When we have an installment sale, the revenue from that sale is not reported with net sales on the income statement. Gross profit will be a separately reported item on the income statement. So the sales and the associated cost of goods sold is not reflected on the income statement for installment sales. Instead, just the deferred gross profit that is recognized in a period. The balance of gross profit will be carried either on the face of the income statement, which is very rare, or in a footnote to the financial statements, which is much more common. So let's take a look at a problem where we're going to apply the installment sale methods. And there are two methods. When we talk about installment sales, there are two methods that can be used: the installment method and the cost recovery method. We're going to use the facts presented in exercise 5-3, which are fairly simple. We have 2 years that we're looking at, 2013 and 2014. In 2013, we had installment sales of $360,000, and the cost of those sales were $234,000. So let's begin by looking at the installment method and using 2013 first and then doing 2014. So let's determine the amount of gross profit for each year. And this begins with the calculation of the cost recovery percentage, which is our cost of goods sold divided by the sales price. So here we'll take our cost of goods sold divided by our sales price, and we have a 65% recovery rate. That means for every dollar that we collect, 65 cents will go to recovering the cost of goods sold. So in 2013, we collected $150,000 from the sales that we made, the installment sales we made in 2013. So the amount of cost that were recovered was the amount of cash collected multiplied by our cost recovery percentage. So that means of the 150,000, we're going to allocate 97,500 to cost, and the remaining amount, the collection minus the cost recovery, is our gross profit for 2013. So in 2013, the initial gross profit from the sale is our selling price minus our cost of goods. The gross profit of $126,000 has to be deferred until we have collections. Well, in 2013, we collected 52. We had gross profit recognition of 52,500, and that means we have a remaining balance to be collected in future years, a gross profit of 73,500. Now in 2014, we collect an additional 100,000 off of the 2013 sales. So in the next period, our customers send in $100,000. So the cost recovery is going to be the $100,000 times the cost recovery percentage, or 65,000, and the amount of gross profit that we're going to recognize in 2014 is 35,000. Now in 2014, we also have additional installment sales, and the terms are slightly different, and that's going to result in our cost recovery being different. So our cost recovery percentage in 2014 is the 2014 cost of goods sold divided by the sales. So we have a 70% cost recovery. So in 2014, 120,000 was collected from customers, and our cost recovery is going to be 70% of that, or 84,000, and our gross profit will be 36,000. So to determine the balance in our deferred gross profit account, which will consist of both the 2013 sales and 2014 sales, we're going to look at the 2013 sales. Oops, can't do that. So again, the initial gross profit is the same. The amount that we recognized in 2013 is the same. And in 2014, we recognized an additional 35,000. And I'm showing the prior year's gross profits as negative numbers, so we can make our calculation based on the sum factor. In 2014, we had additional sales. The gross profit from those sales is 105,000. We recognized 36,000 in 2014. So the balance in our deferred gross profit account at the end of 2014 is going to be the sum of all of these numbers, or 107,500. The other method that we can choose to implement is a bit more conservative. It is called the cost recovery method. It is typically used when we're dealing with very high-risk customers, and this will delay the recognition of any gross profit until all of the costs have been recovered. So let's go back and look at our same facts. In 2013, we had installment sales of 360,000, and they had associated cost of goods sold of 234,000. So we will not recognize any gross profit until we have collected $234,000 from our customers. So in 2013, we collected 150. All of that is going towards cost recovery, and we have zero gross profit recognized for 2014. So again, our initial gross profit from the sale selling price minus cost of goods, is 126, but we recognize zero gross profit in 2013. So we have a balance of 216, all of the 126,000 in gross profit from our installment sales. In 2014, we recover an additional 100,000. So the amount of cost that we will recover is our cost of sales minus our prior recovery, or 84,000, and then the gross profit for the period is the collection minus the cost recovery. So we've collected all of the 234,000 in cost of goods sold, and every dollar we collect after this will go towards our gross profit. So our total gross profit from these transactions will be 126,000 if we collect on all of the accounts. We recognized zero in 2013, and we're recognizing 16,000 in 2014. In 2014, our sales, our installment sales, were 350,000, cost of goods 245, and we collected 120. Again, all of that is going towards cost recovery, and we'll have zero gross profit recognition in 2014. So in 2014, our gross profit from our installment transactions, our selling price minus our cost of goods sold, is 105,000. We've recognized zero. So the balance in our deferred gross profit account, using the cost recovery method for 2013 and 14 installment sales, is going to total, I think I made an error on that, 2013 and 2014, total 215,000. So using the cost recovery method, we have recognized a lot less gross profit, and we have a lot more to be recovered in the future. So again, it is the more conservative of the two methods. Let's take a look at how journal entries would play out, and we're going to be using journal entries that are summaries of many transactions, but it'll give you an idea of the flow of information through the accounting system. When we have an installment sale, the initial journal entry will be a debit to accounts receivable. You could also call it installment receivables if you wish. Well, the customer has left with the inventory, so we're not going to recognize any cost of goods sold yet, nor are we going to recognize any sales revenue. We're simply going to reduce down the inventory by the amount that the customer has taken, and then we're going to recognize an account called deferred gross profit. This is a permanent account. This is a balance sheet account. So for 2013, under the installment method, we will increase our receivables by the amount of the sale. We'll reduce down inventory, and the difference will be deferred gross profit of 126. As cash is collected, obviously we're going to increase cash. So in 2013 we collected 150,000, and obviously we're going to reduce down our accounts receivable. But when we collect the cash that allows us to recognize some deferred gross profit, the deferred gross profit will be reduced through a debit and instead we will, instead of crediting revenue, our credit is to realize gross profit, the realization being the collection of the cash. So we said we were going to recognize 52,500, and those are our journal entries. The accounts used in each succeeding year will be the same in the subsequent year, and it will be exactly the same in the cost recovery method. In the cost recovery method, again, we would increase our accounts receivable by the sales, reduce down the inventory, and the difference would be our deferred gross profit. When we receive cash, we'll increase our cash account, reduce down our accounts receivable. Well, since we did not recognize any gross profit, excuse me, since we did not recognize any gross profit, we would not make an entry involving the realization of any deferred gross profit. That's going to have to be postponed till the subsequent year. All right, in 2014, under the installment method, our accounts receivable will increase by our 2014 sales, inventory reduced by the cost, and our deferred gross profit is the difference between the two, and that records this $214,000, 2014 installment activity. Now, our cash collections will be comprised of two installment flows, 2013 and 2014. So we'll collect the 100,000 from the 2013 sales that were collected in 2014, plus the 120,000 that was collected in 2014 for 2014 installment sales. The deferred gross profit under the installment method will be the realized gross profit of $35,000 related to the 2013 installments and $36,000 that we recognized for the 2014. Under the cost recovery method, again, we'll be recognizing the same amount of cash the same amount of receivables, same amount of the reduction of inventory, and then the difference between the two is our deferred gross profit. We collect the same amount of cash as we did under the installment method, but now our deferred gross profit is only related to our 2013 sales, where we have exceeded cost by $16,000 cumulatively. Again, going forward, any 2013 sales will all go to gross profit. 2014 we have an additional $125,000 in cost to recover before we can recognize any gross profit. And that is the installment gross profit method.